which stock carries more total risk? The total risk is the volatility, right? And then the market risk is perceived by the beta. So which stock carries more total risk?
I think BIS.
Yeah, Disney's have more volatile than Chipotle. So how about the market risk? Which one have more level of market risk?
Also BIS.
Takes a lot.
Oh, so,
Hmm?
can you get back to that?
Yeah.
So, Disney has more market risk, right? Because of higher beta, but the Chipotle have more total risk with its volatility is,
Yeah, the Chipotle has a higher volatility. Yeah.
okay.
But do you know how to calculate the volatility? That's my question for you. So how do we calculate the volatility number here?
So,
Variance, yeah, either by using variance or standard deviation.
so at the time we have to have the expected of the return, right? Because we need to calculate the variance of RI, so we need to have the mean of it.
Yeah, the mean of it, just calculate the mean of the whole return of stocks, and then the deviation from the mean is basically the variance. Okay. Yeah, let's do another example, very similar to the first one. Done. Yeah, so can someone tell me what is the cost of capital for Walmart?
5 or 6%.
Yes, how about Johnson and Johnson?
That would be 8.32%.
Yes. So you know how to do it right now, right? It's just very simple. Just apply the CAPM formula. Okay. Now let's quickly go through. I think Mark has covered everything in the market portfolio, but just quickly go through it before we come to the next example. So this is the calculation for the market capitalization. It's just like simply you use the number of share outstanding times with the price per share. So this is the way we calculate the market capitalization. And then the market portfolio is basically the value weighted portfolio, a portfolio in which its security is held in proportion to its market capitalization. So we just weighted every single stocks by using the market cap. So now we have some market indexes here. For example, like we have S&P 500. So this is a value weighted portfolio of the 500 largest US stocks. So currently in the US, there are around 5,000 stocks, trading stock actively on the market. But for S&P 500, we only take into consideration of the 500 largest US stocks. So here have like view size of 5,000 for the. So this is for for other stocks as well, currently listed in the U.S. Stock Exchange, and we have Dow Jones Industrial Average. Dow Jones Industrial Average is the longest trading indexes of the 30 largest industrial stocks. So investing in market index is like, so if you have learned from the asset pricing, you know that it's really hard to outperform the markets. So one of the safest option is to try to invest in the market index rather than invest in the individual stocks. So index fund is mutual fund. Normally in mutual fund we invest in the S&P 500 or the Wilshire 5000 or some other index like the Shanghai, the Shenzhen index. And we also have some exchange traded funds trade directly on the exchange but represent ownership in a portfolio of stocks. So most practitioners basically use the S&P 500 as a market proxy, even though it's not the perfect example of the market portfolio because it only contains 500 largest listed firms in the US. So now, when we have the market portfolio, we have the expected rate of return on the market portfolio. Now we determine the risk-free rate by using the yield on the US Treasury securities, and we calculate the historical risk premium, the difference between market rate and the risk-free rate. So here is some, this is the historical excess return, the difference between the S&P 500 compared to the 1-year Treasuries bills and the 10-year Treasury bill. So you can see here, this from the longer period, from 1926 to 2015, the risk premium is much higher than for the relatively shorter period from 1965 to 2015. So this is the excess return, the difference between the S&P 500 and the T-bonds. So the basic idea of this slide is if we use historical data to calculate the cost of equity, it's going to have some drawbacks. For example, like the standard errors could be large and it may not represent the current expectation. That's why in practice, practitioners normally use the CAPM model to calculate expected cost of equity rather than using the formula here, to calculate either the dividend yield and the expected dividend growth rate to determine the cost of equity. So here is the definition of beta. So beta is the expected change in the excess return of the security for a 1% change in the excess return of the market portfolio. And then you see the graphs, I think Mark has talked already about it, right? Yes. So this is just the scatter plot. So you can recreate this plot if you use the Excel file and you do the scatter plot. So this is the S&P 500 excess return, and on this line you have the Cisco excess return. So it's like this is the KM line, the best fitted line from the regression. So the slope of this line is beta. Any question? Okay. So if you use this scatter plot, you can see that Cisco tends to be up when the market is up and vice versa. And then you could see that the 10% change in the market's return is corresponding to about 16% change in the Cisco return. So the Cisco returns moves about 2 for 1 with the overall market. So if you find here, you can see that the Cisco beta is about 1.6. So it moves 1.6 times more than the market portfolio. So here it's still about the historical return, it's about the beta. So beta, basically the slope of the best fitted line is the plot of the security excess return versus the market excess return. Okay, so it's all about the linear regression, the security market line we have discussed prior. And then, yeah, it's about the alpha. So alpha represents a risk-adjusted performance measure for the historical return. So if alpha is positive, it means that the stock has performed better than predicted by the KPM. Okay, so let's do the example. Now, you have the beta, you have the confidence interval for the beta, and you have risk-free interest rate, the market risk premium. Now you calculate the equity cost of capital. You need to calculate the range for it. The range, because the beta here have two range, right, to the confidence interval from 1.3 to 1.8.
Like the lower bound would be?
The lower bound is,
9.5%.
and how about the upper bound?
12%.
See? Yes, correct. Any question? Oh yeah. So now let's do the next one. Can someone tell me what is the upper bound of the cost of equity for Tiki Bird?
I think
8.5, right? Yes. Yes. Yeah. Do you get the same result, Lynn? Now, let's move to calculate the debt cost of capital. So, now let's recall about Mark lecture. So how do we calculate the debt cost of capital? Yes, cost of debt, whatever. Remember it?
Interest.
Give me an idea.
Interest from the debt.
Not really. Let's do ACC weighted average cost of capital. We need to determine the cost of debt first. So it seems to be everyone is more comfortable to calculate the cost of equity.
Yeah.
So for cost of debt, there is two ways of calculating it, either by using the CAPM or using the probability of default. Now, let's go through it.
Or what is? You said there are two ways, one cap and
The probability of default and the CAPM. The probability of default is a more straightforward one rather than the probability. The probability of default is better way to calculate the cost of debt rather than the CAPM. Now, the first thing here is that if you use the interest rate or the yield to maturity, so if the firms have little risk that it's going to default, the yield to maturity is a reasonable estimate of the investor expected rate of return. But in the case that the firm bears several levels of default, we need to take into consideration the probability of default into our calculation of the debt cost of capital. Now, so if you consider a 1-year bond with a yield to maturity of Y, so for each $1 invested in the bond today, the issuer promises to pay $1 plus the yield to maturity in 1 year, right? So now, suppose we have the probability of default of P. So now, the bondholders receive only 1 plus the yield to maturity minus the probability of default. For example, we have 60% of default, so it's gonna be 1 plus the yield to maturity here minus the probability of default. So, is the expected loss per $1 of debt in the event of default. Any questions so far? Yes. So the expected rate of return of the bond is, so we have the cost of debt minus equals 1 minus P here is the probability of default times with the yield to maturity. And in the case of default, now we need to take into consideration of the expected loss rate. So if we rearrange it, it's gonna be the yield to maturity minus probability of default times with expected loss rate. So the adjustment depends on the riskiness of the bond. So this is the way we calculate the cost of debt. So it's equal, one here is the yield to maturity or the internal rate of return minus probability of default times with the expected loss rate. Any questions so far? As we have annual default rates by debt rating. So this is for different rating of debt of the corporate bonds, corporate default. So we have different levels of default rate for the equivalent bond rating. And then this is the on average, and then in recession you will see that the default rate is much higher than in the normal business period. So the average loss rate for unsecured debt is 60%. Yeah, and during the average time, the annual default rate for B rated is 5.5%. This is the first way we calculate the cost of debt. We use the probability of default and the expected loss rate according to the rating, Moody Global Credit Policy Rating. Okay, and then
Okay, can I ask it's just like 1 year? What kind of duration? Because I remember seeing another table, but like they have different year period, different period. Like 1 year, default rate for 1 year, default rate for 2 years,
mhm.
for different type of things. So this is just
This is the annual default rates by debt rating from 1983 to 2011. Yes. Okay. Don't worry, we are going to have another table. You will see. Okay, so now, if alternatively, if we don't use this formula to calculate the debt cost of capital, we can use another formula by calculating by KPM. This probability of default. So another way of calculating the debt cost of capital is we're using the KPM. So if we're using KPM, it's similar to the way we calculate for the equity cost of capital. This is, we use the beta, that the risk-free rate here is the risk-free rate for risk-free, default-free bond, or you could use it for T-bill, and then beta, this is the debt beta, not the equity beta. And now the market's risk premium for debt. So it's very similar to the equity cost of capital, but this one, we have the different market's risk premium for debt, and then different debt beta. Now, why it's not really popular in the products? Because for investment bankers or for research analysts, for sales side analysts, we normally use the bond rating. So we calculate the debt cost of capital by using the probability of default and expected loss, rather than the KPM, because the debt betas is not really common in practice. Debt betas are very difficult to estimate because the corporate bonds are traded infrequently. We do not have the very active market for corporate bonds compared to stocks. So one approximation could be used to estimate the beta is by using the bond indices by rating category. So what key assumption here is that if different corporate bonds belong to the same category, rating category, it's gonna pair the several level of debt beta, the sensitivity to the debt market portfolio. So I think that could be the table you are talking about, right, Hui? The average debt beta by rating and maturity, isn't it?
Yeah, but I have to the professor gave us the different one for each year, the default rate for each year.
Mm-hmm.
And this is like average one.
Yes, yeah. So you could use this one to get the debt beta, and then apply the debt beta into the KPM model to calculate the cost of debt. Okay, so now, any questions so far? Any question? Any issues? Comment? Okay, so now let's do the problem. Here we go.
So can you show us like how can we have the probability of default in this case for constraints impossible?
Hmm? Probability of default. The expected loss rate is 60%. This is the probability of default.
I thought that it's just the L
Hmm?
expected loss rate
Yeah.
loss L is just loss and PL is the expected loss rate. Is that what you the L here is expected loss or expected loss rate is
The expected loss here is 5.5%. I think, let me see.